As we enter into the third week of the partial government shutdown, a bigger and more dangerous threat is looming in Washington, D.C. this morning. In 2 days, our government's going to run out of money to pay its bills. So what will happen if Congress can't vote to raise the debt ceiling before then? Well, this morning we're finding out. Sundaram is an economy professor at GVSU. He's helping us answer that question right now. So let's start there. There has to be a deal done today, you're thinking, and there seems to be some optimism. And even as we're looking at these markets here, they're reacting positively because they think there's going to be a deal today. And there have been some indications there will. So you're saying it's got to be done now.
That is correct, Brett. Even yesterday, if you look at all our markets, closed positive. And today, the international markets are all, almost in the positive section. So really what they're all looking at is the Senate is coming up with a deal. They has to happen now because they have enough time to then send it to the House and make sure that we have a deal. Therefore, the money is ready to flow out on the 17th.
Okay, so we're going to look at it from a positive perspective there. It's going to happen. But now let's take a look at it from the what-if perspective.
Right.
What if, for example, this deal doesn't happen? What if they can't come to an agreement here and that we go past that deadline, that debt ceiling deadline? Now, there are two schools of thought here. One is what the the treasurer is saying that essentially that we're going to be in a big trouble. Right. The other school of thought is that it's not that big a deal and we can survive it. What's your thought?
Well, I think, Brett, we learned a lesson in 2011. We tried this before. The market reacted negatively, substantially. We dropped about 2,000 points. We saw the first time ever downgrade on our U.S. Treasury debt. We don't want to go that route. So certainly, the Treasury has a choice. If we don't have a bill passed, who are they going to cut? Not pay the military? Not provide Social Security checks? Are we not going to fund our essential programs? So it's really I think the Senate has to come to a deal. The markets are really going to put some significant pressure. The international markets already are looking and saying, this is a sovereign debt. This has a significant impact for everybody. Yeah,
I mean, this isn't just something that has to do with our local debts. This is a worldwide issue here because China holds a lot of debt.
Over $1 trillion.
Yeah. And they're not going to be pleased with that either if we do decide or go past this debt limit.
You're absolutely right. And the recent comments from the Chinese government has been very clear that, the U.S. government has to figure out a way to balance this and come up with a clear thing for passing the debt ceiling limit because they're holding over $1 trillion of debt, and that they don't want to see that have a huge impact.
Yeah. Well, I'll tell you what, that's the impact from a worldwide perspective. That's an impact from the U.S.'s ability to pay back its loans and debts and whatever else it may have incurred here. But the real question is, what's that mean for anybody that lives in West Michigan? Right. That's the real issue here. So we're going to ask you to stick around, Sri. We appreciate your time here. And make sure to stick with us because coming up at 6:40, Sri's going to be breaking down what it means for us if the U.S. defaults on its loans. Should we be worried here in West Michigan? What should we be doing to get ready? He's answering those questions for us in our next half hour. 6:42, welcome back. Lawmakers in Washington running out of time to work out a compromise. In just 2 days, the federal government could hit its limit on borrowing and no longer be able to pay its bills. Now, in the last half hour, GVSU professor Sundaram joined us here, broke down what this all means if we think the danger is real or not. He thinks it is. Well, now he's joining us again to explain what kind of impact it would have on you if they don't reach a deal. So we're kind of looking at a worst case scenario here because we're hoping they're going to come up with an agreement today.
Correct.
But let's say they can't because they haven't really shown that they are able to reach any kind of compromise, right? Okay, so if that happens, the things we need to worry about for anybody that lives here in West Michigan, the first thing would be your 401k. What's going to happen there?
Brett, I think, again, going back to history, looking at 2011, we see the financial markets are going to react very negatively. So far, year to date, all the indices are showing about double-digit gains. The last thing we want is for people to see their 401k take a hit. We had one hit in 2001, again in 2008, a minor hit in 2011. We certainly don't want to see that again.
Well, I think a lot of people that saw that huge hit in 2008 and during that time have actually made that money back and then some now because they stayed in the market. But the problem here is we may see another big one too.
Exactly. And if you have several people who are close to retirement kind of are looking at it and saying, maybe this is the time for me to, get out. And this may, so certainly they're looking at this very cautiously to see whether we're going to have a deal.
If they don't come to an agreement today, they should probably be calling their financial advisor.
Absolutely.
Figuring out something what they can do there. Okay, so let's talk about borrowing costs because that has an effect too.
Right. You're absolutely correct. The housing market is starting to come back, but any time we see a downgrade on the U.S. Treasury, we're going to see certainly the borrowing costs go up. And that's going to have an impact right away on the housing start, and that means the economy is going to be affected. As housing goes the rest of the economy. Yeah. So we certainly don't want to tip. Our economy has really bounced back. Second quarter, we had a 2.5% GDP growth. We certainly don't want to see that slowing. And more importantly, if they don't arrive at a deal pretty soon, we're going to see that tipping to the other side.
You can see your interest rate on your mortgage go up if you're looking to get a new mortgage here or it's not locked in. You can also see interest rates on your credit cards go up too, right?
Absolutely. Any borrowing costs, all of those are going to be benchmarked to the Treasury security borrowing costs, and therefore clearly we're going to have a spike in the borrowing costs.
Federal funding. What do you mean by that when you say federal funding?
Well, we have several programs. We're already, that's being funded by the federal government. And whether you look at, for example, you look at some of the research programs, NSF funding, all of that has been stopped. And so when we look at it and say, what happens if we don't have a deal and the Treasury is not able to, open up in the coffers and be able to pay some of these programs out, then we really have a problem. And my biggest concern is really looking at the overall economy. As we don't, if we don't support the economy, we really are progressing well. We could easily be going at a steady pace. Now we're going to be regressing back, and that's my biggest fear.
And all of this is basically self-inflicted damage that we're doing to ourselves. Exactly. We don't have to do this, right?
That's the irony of the whole situation.
All right. Thank you so much, Sundaram. We appreciate your time.